Welcome to our video guide on futures. But before we dive in, it's important to note that this video is intended solely for educational purposes. It's not financial advice, nor should it be interpreted as such. Always conduct your own research and consult with a professional financial advisor before making any investment decisions. Now, ready to learn about futures? Let's get started. Have you ever wondered what futures are? You might have heard of them in the context of finance, but what do they actually mean? Imagine you're a farmer growing wheat. You might want to ensure that even if wheat prices drop in the future, you're still going to make a certain amount of money. This is where futures come in. Visualize a futures contract as a unique kind of deal, an agreement struck between two parties. As an image of two individuals exchanging contracts on screen, imagine they're negotiating to buy or sell a defined quantity of a specific asset at a set price on a future date. It's akin to making a commitment for the future. Thus, the title, Futures. Now, why would anyone want to make such a promise? Well, it's all about risk management. Going back to our farmer, he might be worried that wheat prices will fall by the time he's ready to sell his crop. So he could enter into a futures contract to sell his wheat at a specific price in the future. This way, he locks in a price now and eliminates the risk of falling prices. But futures aren't just for farmers or commodity traders. They can be about any asset: stocks, bonds, currencies, even interest rates. And they don't necessarily require the asset to physically exist. For instance, you could have futures on stock indices or interest rates. Now, it's important to remember that futures are zero-sum games. That means for every winner, there's a loser. If the price of wheat rises, the farmer would have been better off without the futures contract, but the person on the other side of the contract, let's say a bread manufacturer, benefits from the locked-in lower price. One more key point about futures: they are traded on exchanges. These exchanges standardize the contracts in terms of quantity, quality, and delivery time of the asset. This makes the contracts more liquid, meaning they can be bought and sold easily. To recap, futures are contracts to buy or sell an asset at a predetermined price at a specified future date. They're used for risk management, to lock in prices and reduce the risk of price fluctuations. They can be on any asset and are a zero-sum game. And finally, they are traded on exchanges, which standardizes the contracts and makes them more liquid. So the next time you hear about futures, you'll know it's not about predicting the future. It's about making a promise for the future, a promise that can help manage risk and provide certainty in an uncertain world.